So I am the client director at Baillie Gifford who looks after Scottish Mortgage, working very closely with James Anderson and Tom Slater, the two fund managers for Scottish Mortgage. So Scottish Mortgage Investments Trust core proposition is very simple. We provide long-term investment in great growth businesses around the world at the lowest possible cost for shareholders, in the belief that this offers them a genuinely differentiated proposition from that they can get elsewhere. We take a long-term approach to investment for Scottish Mortgage, by which we mean we have a time horizon of 5 years and beyond. Because we believe that if you want to produce differentiated returns, you have to do something different from other investors in the marketplace. And we know that many people have much shorter time horizons. Our long-term approach is reflected in our portfolio turnover of between 10 and 20% per annum. We believe that it's only over these long-term periods that managerial expertise really comes to the fore, that companies' extraordinary ambitions start to pay off, and you see the investment benefits of the extraordinary growth companies that we have in the portfolio. So not only is Scottish Mortgage long-term in its approach to investment, it is also focused on finding the best growth companies we can anywhere around the world, operating in any industry. Many long-term investors focus on the notion of value investing, but we believe all investors think about the price they have to pay today and what potential for return generation might be over their time horizon. Taking our long-term approach, focusing on great growth companies who are able to sustain their competitive advantages for long term, whose management teams are there to create something extraordinary, gives us the opportunity to own the handful of businesses, those really outstanding companies that we know actually generate the majority of returns in equity markets over the long term. So over time, Scottish Mortgage has grown its assets predominantly through performance to become the largest conventional investment trust and a FTSE 100 company. Why does this matter to our shareholders? Well, it's important to take a step back here and say that's because we, Baillie Gifford, have passed on the benefits of scale to shareholders through bringing down our annual management charge each and every year to reflect the benefits of scale in the company. So today, the annual management charge is 30 basis points, that's 0.3% on the first 4 billion of assets, dropping to 0.25% thereafter. What that means is that as the company continues to grow, shareholders will continue to see, all else being equal, shareholders' costs come down. Now, this really matters whether you're our largest or our smallest shareholder. Many investors see costs in terms of the total assets of a company, but actually it's probably clearer to think about it in terms of the returns that we generate from shareholders from using their capital. So if you have an ongoing charge, as we do, of 37 basis points, and we compare that with, say, a charge of 1.5%, in percentage terms, that doesn't seem that much greater. But if you consider a 10% per annum investment return, that's the difference between taking a little under 4% of that return generated from your assets, compared with 15% in just 1 year. And if you think about it in the long-term time horizon that we invest for Scottish Mortgage, the compounding of those differences really starts to make a difference for all investors. And that's why we think our low-cost focus is so important for all our shareholders. And it's something that the independent board of Scottish Mortgage is very much in alignment with us as managers of the trust. So one of the shifts that we've seen in recent years is companies remaining private for much longer. Let's take an example. When we first invested in Amazon for Scottish Mortgage back in 2005, its valuation was under $20 billion. So by 2012, when we got the opportunity to invest in Alibaba as a private company, we took that opportunity. By then, it was already the dominant e-commerce platform in China. It had a valuation of over $45 billion. It subsequently became a public company in 2014 at an initial valuation of $168 billion and immediately shot to $200 billion in the first day of trading. And that is something that as an investment trust, we can really take advantage. We have a closed pool of capital. So we, unlike an open-ended fund equivalent, we don't need to sell or buy our investments to create or redeem units for our shareholders. They can simply trade the shares on the London Stock Exchange. This means we have the flexibility to invest in such private companies and then continue to hold them once they become public companies, so long as the investment case remains intact. And that really matters for the long-run compounding of returns that we see from the growth generating returns over the long term from businesses fundamentally growing their operating assets. This is not about us changing what we do. This is about us maintaining our existing opportunity set. When we invested, for example, in Spotify, the global music streaming business, it was facing much the same challenges as Amazon at the beginning, convincing us all that we would listen to music digitally through their platform. But it was already a global business, and we see it as very important for investors to have access to this. And I would bring it back to our low-cost structure for Scottish Mortgage. We don't believe there's another vehicle that offers this sort of access to some of the best growth companies in the world that are still private today, at 37 basis points of ongoing charges. And we think that really matters, that investors get access to them. And that's what we're doing for Scottish Mortgage. So one of the questions that we get asked quite frequently is, how do we actually access these private opportunities? Well, very often they come through our deep relationships with big public companies. So for example, our largest investment to date in a private company would be in Ant Financial, which is the financial services platform that Alibaba has created. Now that's a company with a valuation north of $160 billion, but it's still a private business. And we believe that it's really important for our shareholders to have access to that. But what's happened over time as we've invested in first Alibaba, then Ant Financial and others, is not only have we seen companies giving us access to companies they're creating, but the reputation from doing that, the reputation for being genuine, actual investors in businesses there for the long run, holding our shares and not trading in and out as market volatility dictates, has meant that we now find that companies want to come to us. They want long-term owners on their share register who are prepared to support them in their long-run ambitions. And our ability to hold both as private and public companies actually differentiates us from many of the other investors in this area who have private equity fund structures with a limited lifespan, who have to sell out when these companies become public. And actually that gives us something that not many can offer.